Welcome back to another episode of Gimme Some Truth. Today we are talking about a topic that's getting a lot of headlines recently called pledged asset lines. We're going to talk about what they are, the pros and cons, but we also have a blog post on this as well that gets into much more detail than what we're going to cover today. And obviously, if you want more information about it after you listen to this, we're happy to answer those in a direct meeting as well. So apparently, a little bird told me that Alicia has a joke about pledged asset lines, PALs, as they're known. Alicia, always good to start with some humor. So let's have it.
So pledged asset lines have been around for a while. They're called PALs as an abbreviation. We're here to talk about a new option that is not your pal, it's your best friend. Because it is.
Was that the joke?
That is the joke.
Oh,
yeah.
Fantastic.
Always great to ask, was that the joke?
Start with a little humor.
Nate. Thanks, Nate.
Start with a small amount of humor.
But we will tell you why it's better than a pledged asset line and truly can be your best friend. I think I'm very excited about it. So
yes, you have two people here today, Ian and Alicia, that love this topic because there are tax benefits that are very, very unique to some of the products in this world, and so that hits home with both of them. But Alicia, just real general, high level, what is secured lending just in general? What does that mean, and why should people care about it?
So if you have a taxable investment account and it has a bunch of appreciated positions in it, individual stocks, ETFs, and you want to access that money, instead of selling those positions and realizing those gains, you can get a pledged asset line. And basically you're putting up your investments as collateral and borrowing money based on the value of your investment account. And then you don't have to sell anything in the account. Those loans are pretty high interest rate. They're about 8% right now, but it's a great way to access the funds in your account without having to sell anything and realizing the gain on it.
There's other options other than just pledged asset lines. Ian, what are other options that are almost becoming kind of real as the days go by? I mean, these are changing so quickly nowadays.
Yeah, they are. So there's a new version of this that has only recently become available to individual investors like us and our clients. So there's a strategy that that big institutions have been using for a long time. It's called a box spread loan, and we will go into all the details on how this works in our blog post. It's very interesting. It deals with options, and it's very technical. So we don't need to go into the detail about that right now. But what the high level we want everyone to know about is there's a new way of borrowing against your taxable investment account that does not require you to do a traditional securities-backed loan. It creates liquidity. It uses your money as collateral. It does all the same things, but it has all these new benefits. The interest rates are much lower. The tax treatment is much better. There are much lower minimums. For example, I think many pledged asset lines, you have to borrow at least $100,000.
Yep. You
can borrow as little as $10,000 with the new box spread loan products. So high level, this is something that we offer to our clients. It is something that you need an advisor to do. At this point, it's not yet available to just retail investors without an advisor.
Yeah, and I think it opens a whole new area of borrowing in a way that people haven't thought about before. Home equity loans have been around forever and a day. Those were popular because I own a home, I have equity in the home, my home goes up in value, therefore creates an asset for me, and I can borrow against that. This idea of borrowing off of our assets by way of a brokerage account is not a new idea, as Ian pointed out. Higher net worth and more institutional investors have been doing this a long time. We're now seeing this downstream, as they say, down to people that kind of your everyday investor. Yeah. It's really cool to see.
And they've done a really good job of making this accessible to people. The minimums are only $10,000. With a pledged asset line, you have to borrow at least $100,000. So you can use this for much smaller borrowing amounts if you want to. And interest rates are somewhere in the 4% range, where pledged asset lines are 8% right now. Or if you look at a home equity line of credit, that's probably going to be closer to the 7-8% range as well. So the interest rates are really favorable. In addition to likely the interest that you're paying on these box spread loans, you can likely deduct that on your taxes, where a traditional pledged asset line you can't. And a home equity line, that also depends on what you use the funds for, and there's some stipulations there as well.
Yeah, it's just a really interesting area that we've seen a number of our clients use effectively from kind of any number of reasons where they would have traditionally just defaulted to either a personal loan or a home equity loan.
Yeah, it's this is essentially freeing up capital that would otherwise be locked behind this big massive wall or gate of capital gains tax, right? And so people have always been looking for ways to tap into that liquidity, but now with these box spread loans, we can do this in a much more tax favorable way at lower rates. So it's really kind of like a win-win. Like rarely in life is there sort of something that's like absolutely better in every way.
Sure.
But I feel like we've been able to build up partnerships with other institutions that are offering these products, and sometimes we do have these wins where you show this to a client who's interested in some liquidity, and they're like, oh, that's great. Like I haven't had anyone look at this and say I don't like this. It's like every time every client looks at this is like, this is what I want to do. This is the answer to all my problems.
Yeah. Let's
not for everyone though, but for many people, this is just an absolutely better alternative for liquidity.
So let's take a scenario. So I'll make up a scenario, right? So 10 years ago, I bought $100,000 worth of ABC styled, make up a stock, ABC stock, and it's now worth $500,000, right? So I bought it for 100, it's now worth 500, $400,000 of gain, and I want to access some of that money. Well, if I'm going to access $1 more than $100,000, I'm going to pay tax on my gains in that account, right? And so how is this different for somebody?
So this makes it so you don't have to sell anything in your account. You can still hold on to that investment, and you're basically putting up that investment as collateral to do this loan. And then at some point, if you do want to sell that position to pay off the loan, you can do it that way. And then as you're building up, so the interest on this loan is actually treated as a capital loss. So you can set this loan up, maybe you can do 1 month to 5 years. There's a flexible terms. You can do it as a line of credit, or you can do it as a fixed term. But at the end, you'll have built up the interest rate as capital losses. And then you can use those losses to potentially offset any gains that you realize if you do decide to sell that position at some point, or you're waiting until maybe you're in a better tax situation in a lower tax bracket. So it allows you to access those funds without having to realize those capital gains.
So in my example, my balance is $500,000 today, right? Roughly how much can I borrow of that $500,000?
You can borrow up to 85% of the value of your collateral account. So
it depends on the underlying investment.
Depends on what makes up the account.
And
right.
so, when you use stocks investments as collateral, the issue that this has been around for 100 years, where if the market goes down, the value of your collateral account goes down, and so the one of the risks of doing these securities-backed lending products is that you have to maintain a certain LTV or like loan to value ratio, right? So if your collateral goes down, you might have to make a margin call to put up money to top up your collateral account, but that's pretty rare. And the provider of this loan has set things up so that's unusual to have to do that. But what Alicia, I wanted to jump in and say, like in your example with the ABC stock, because this lending option creates capital losses, you can immediately say you don't want to be all in ABC stock. Maybe you want to diversify out of this one position. Maybe you sell some of that position, realize $100,000 of capital gain, borrow money against that position, then you have a built-in capital loss from this lending program to offset the $100,000 of gain that you've just realized. So it's sort of like it solves, in this scenario that in your example, it is solving the liquidity problem, and it is also allowing you to diversify, and it is also allowing you to eliminate capital gains tax. So that's why it's so attractive, right? And because in your example, at $400,000 of unrealized gains at the highest long-term capital gains bracket of 23.8%, we're talking about a substantial tax bill. But what if I told you, well, you don't have to sell, or you couldn't sell, but there's no tax, and you also get, 85% of $500,000 in liquidity at a very low interest rate to go do whatever you want, go buy a house, consolidate credit card debt, take a vacation, pay for a wedding, any of the things that people do with their money, which is infinite.
Or even bridging the gap between, like, if you temporarily need funds for something and you say, oh, I have this liquidity event coming up, but I need money right now, you can use this to bridge the gap until maybe, I've seen people in situations where they're trying to buy a new home and it's a competitive market and they need to be able to put down that down payment before they've sold their old house. There's a couple of different options to do that, but depending on your timeline, you could use something like this, knowing that as soon as you sell your old house, great, you can now pay off that loan.
And I think that Ian brings up a great point, which is the market does fluctuate, obviously. And so, one of the downfalls and this isn't necessarily a downfall in terms of how the product is built, it's just the nature of what we're talking about here is that, if the market falls drastically and you have and the reason why I used an example of just one single stock is because, if that stock fell, you are subject to kind of squaring that up. Yeah. However, if your portfolio is built with a diversified mix of investments or it has more bonds in it and it's seen as being less volatile, then, that is taken into consideration when these accounts are set up.
Yeah. So if you have one individual stock, you're not going to be able to borrow 85% of the value of the account. But if it's all treasury bonds, they're going to let you borrow more. Right. In one individual stock, you might be limited to 50 or 60% of the value. And then,
but that's for your protection as well.
Yes. Yeah. Right. Yeah. Because if that stock drops and now suddenly that loan to value ratio is out of whack, then essentially it's like a margin call and you're going to have to put that back into square it up.
And Alicia, you were telling me earlier that one of the cool things about this new box spread loan is that there are far fewer restrictions on what you can do with the proceeds.
With the funds,
as opposed to a pledge asset line. So a pledge asset line has some restrictions.
I wouldn't recommend this, but if you wanted to go to do this and go buy additional investments, you could do that.
Yes,
that's not something that I recommend most people do. But there's
you could use it for leverage for your own fund. Trading.
Yeah. Well, and the use of the funds doesn't determine its tax status.
Right.
We're like a home equity line of credit. The interest on that, it might only be deductible if you're using the proceeds to build, buy, or improve your home. Or sometimes with like a pledged asset line or other securities lending, you can't go buy other investments with that money. Where with this, there's no limitations on what you can use them for.
I think ultimately what we found in the use of the use cases that we've seen to this point is just the flexibility. The flexibility, and the speed at which you can get these set up. And I think that's another kind of often overlooked benefit of these accounts is just the idea that if you need money quickly, right? Home equity lines of credit, in some cases can get set up quickly, but in some cases require an appraisal, they require other things. These can, in a lot of cases, get set up much, much faster and give you that access to your investments that just don't necessarily kind of work, if you will, in other areas of lending as it does in this case.
Yeah, like 1 to 2 weeks is what we've been seeing in terms of getting the cash funded.
Yeah. It depends. You have the account set up.
Yeah, it depends on factors, but it's much faster than a HELOC, from my experience.
Yeah, and once you have the account set up, you can do some lending this way, and then you can do additional loans in the future, or have nothing for a while and then do it again. So, in the way that people like the flexibility of a HELOC is, hey, I have access to this line of credit. You can have this set up to be the same way. You can get it set up and not borrow anything at first, but then if and when you need the money, it's all set up and good to go, and then you can borrow the funds as needed.
Yeah, it falls under the category of great new innovation within our industry, but one that does require a good understanding of it, what you're trying to accomplish. This is ultimately why you seek out the advice of financial advisors. We do this every day. Our job is to continue to bring these ideas to clients to say, hey, this is something new. If it works for you, great. If it doesn't, that's okay too. But let's put this idea in front of you if this could fit. Again, they're going to write a great blog post with a ton of detail to it. And if you want information beyond that, obviously book an appointment with us. We'd be happy to talk through your specific situation. So thanks so much for tuning in to another episode of Gimme Some Truth.
Walker Connon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walker Connon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit walknercondon.com.